Vanakkam, Namaskar, and hello to all the viewers and listeners of this edition of Fixed Income Market with Sundaram Mutual Fund. In the upcoming monetary policy, we expect MPC, that is Monetary Policy Committee, to maintain a status quo on both rates as well as on the stance with a hawkish bias. On the inflation front, the print for August 2023 was lower than the expectations with moderating core, and we expect a moderation in the upcoming inflation print on account of tomato prices going into deflation on a year-on-year basis, while other food items, especially cereals and pulses, are looking sticky but not as worrisome as what we saw in tomatoes. Overall, inflation is likely to print in a handle of 5.5%, still a worry from a 4% median target, but on a declining trend. Although the crude prices have been firm and higher than the average of $85 a barrel assumed in inflation projections by MPC, the pump prices are still stagnant, and with LPG prices revised down by rupees 200 per cylinder, it had a salutary effect on inflation. In a nutshell, we think the government will be aggressive in managing price rise with supply side measures, namely banning or curbing exports, allowing imports from cheaper locations, releasing grains from the government stockpiles, etc., as they face elections in large states and then general elections around April 2024. We also expect the RBI to remain on a hawkish pause to support the government's agenda of stable prices. In India, unlike many other countries, we have seen the economy on a firm ground as the high frequency macro indicators like tax collections, credit growth, PMI numbers, cement dispatches, steel consumption, passenger vehicle sales, etc., have been largely robust, while on the external front the exports have slackened. The rural economy, which looked softer, is likely to pick up steam as we have seen good kharif sowing, and festive season should build upon that. Although the monsoon has been deficient, but reservoir levels are adequate to have a stable crop. Globally, the large economies, in addition to Japan, like United States and China, have started facing the challenge of high leverage. We are bringing leverage down causes slowdown in growth, while sustaining higher leverage causes inflationary expectation to rise and thus rates. Particularly in China, the leverage from public debt is not high compared to other large economies, but is rising fast as the corporate sector balance sheet is over-levered and the government will have to step in to stave off the crisis. The lower growth expectation compounds the problem as investors see a Japanification of China. Similarities like largest manufacturer of goods, property market crisis, and aging population. This has aligned at a time when other economies are tightening to control inflation, causing the demand of goods to moderate. We believe that China has taken a leaf out of Japan lesson and not resorted to cut signaling rates relentlessly, instead easing reserve requirements and improving liquidity in the system. In spite of the right direction, we think the timing of the crisis is likely to take China a longer period to overcome the flagging economy due to lower growth and deflation. In the United States, the situation is different, as the economy has largely been resilient but has started showing incipient signs of slowdown, and with the government unwilling to cut expenditure, as United States has the reserve currency status. Only time will tell what will transpire. We believe that questions around the irresponsible behavior itself will not let the level on rates move down sharply. The upcoming presidential elections will not help the cause. India's inclusion in JP Morgan Emerging Market Global Bond Index is a cause of cheer, as it has been a demand from the investor community and no relaxation in taxes have been offered by the government to get them included in the bond index. The flows, both active and passive, should be in a handle of around 30 billion over a period of time, The weight in the index is accorded to India is 10%. Only two other countries have the same weight in Malaysia and Indonesia. The current outstanding ownership of Indian bonds by foreign portfolio investors is around 1.5 to 1.7% and is likely to increase to around 3.2 if the flows happen. Not very high considering it is between 20 to 30% in Indonesia and Malaysia. Though not material at present, the total ownership can be controlled by offering limited securities issued under fully accessible route, a tactic to manage the impossible trilemma. It is said that out of the three, namely independent monetary policy, fixed exchange rate, and free capital flows, only two objectives can be pursued at any given point in time. In general, we think the government has decided to use this route on account of India rising in the global order, maybe a step towards making rupee international and reducing the cost of borrowing without resorting to RBI to monetize the same. Based on this, and in continuation of our earlier stance, we recommend active mid-duration buckets as a preferred route of investment on account of better price discovery due to liquidity, which results in a better capture of interest rate moves. Products which we have in our basket are Sundaram Short-Term Fund, Sundaram Corporate Bond Fund, and Sundaram Banking PSU Fund. Keeping this in mind, we recommend investors to take position in mid-duration buckets if they have 12 to 18 month horizon, and investors with conservative risk appetite match their investment horizon with duration of the product or take position in conservative products like liquid, overnight, and ultra short duration. Thanks for joining us in this episode. Looking forward to see you next month.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.